Debate Eric Johnston, head of equity derivatives and cross-asset at Cantor Fitzgerald, and Phil Camporelli, portfolio manager at JP Morgan Asset Management. Guys, let's start the initial case relatively briefly, if we can, and then we can dig into it. Eric, your view.
Sure. So we think there's more downside to go from here, and it's for a few different reasons. So number one, the Fed has ballooned its balance sheet. It has suppressed real yields. It has really wanted higher multiples and wanted speculation at higher asset prices. That's now about to go in reverse. And we've seen there's been a very high correlation between the Fed balance sheet and PE multiples, and we expect the balance sheet to contract. The second thing is we think earnings estimates have peaked. This is a big deal. Last year, earnings estimates were up by 26% from where they started the year to the end of the year. Now you fast forward to this year, we think they've peaked. Economic data is softening, and this most recent sell-off in equities could even further impact the economic data. And then the third point would be positioning. Investors, for the most part, have not adjusted to this new world, this new Fed world, this new peak estimate world, and we think they still need to adjust. The individual investor has been adding dollars to this market for the past year. They have not turned seller yet, and we think that's going to be a big overhang along with other investor types.
Phil, why do you disagree with Eric?
Yeah, so good to be here, Will. Thanks for having me. So we are still very confident in our view in stocks in a multi-asset portfolio and being overweight stocks in a multi-asset portfolio. And here's the reason why. And again, it goes back to the Fed. And I think some of those concerns that Eric mentioned are warranted. But now, which is very different from last year, the market is hearing the Fed loud and clear. The transmission mechanism is open. So what do I mean by that? So ever since the Fed made their pivot in December, what we've seen this year has been a reduction in the most growthy names, an increase in rates, and an increase in real rates. And Will, I think, one of the things in my career that I've seen is when interest rates go up and stocks go down, people freak out. Right? I think that paralyzes people. But from here, what we would expect is no news is good news with the Fed. It's hard for them to get even more hawkish than they are now with how much is priced into the market. And then you settle into an environment where the VIX, so equity volatility and rate volatility, settle down. And if that were to happen, that creates a really good environment for taking risk. And most importantly, even though the Fed wants to establish credibility on inflation, they do not want to do it at the expense of growth, right? So if you go back in history, 11 out of 12 tightening cycles since 1950, Will, the market has been higher by an average of 9%. So as Mark Twain said, history doesn't repeat itself, but it often rhymes. I think the Fed is in a position where no news is good news. They can't really get any more hawkish unless they're wrong on inflation. And that creates a good fundamental backdrop for taking risk.